Hello, welcome to our sector focus series in which we discuss and strategize how to invest in a particular area of the stock market. Well, this week we take a closer look at utilities, often popular for their generous dividend payments, but not so sought after due to the tight regulation. Well, Russ Mould of AJ Bell is here with me now for more details. So as I say, Russ, hello to you first of all.
Don't nod off on me with this one, will you?
Well, exactly. It's not everyone's cup of tea, and it's not the most exciting thing, let's be honest about it. But there's something to enjoy about it because people buy it up.
Well, yeah, and I think, to be fair, it depends on your style and your investment philosophy and your investment strategy. If you're a trader looking for a bit of a quick kill, I'm not sure this is really the area that you're going to be looking. But equally, if you're a patient portfolio builder looking for a relatively safe bedrock and some income, they're just the sort of stocks that you'll potentially be looking for. I mean, SSE has got a 6% dividend yield with 1.3 times cover for 2017. So the earnings per share are 1.3 times the dividend. Now, that sounds quite low. Really, you'd like it to be 2 or more. But this is a utility. So there shouldn't be a major accident, there shouldn't be an earnings surprise. So with cyclicals, you need that margin for error. Ask Pearson for details. But with utilities, you don't. So you can get away with low dividend cover. And actually that 1.3 times cover at SSE is higher than the average cover for the 10 highest yielders in the FTSE 100. So if, for a yield play, there are far worse places to be looking.
So does boring mean that they're safe?
Not entirely, because they have underperformed, and the shares have actually sort of done nothing over the last 6 months, while everybody's been welcoming that man Donald Trump and getting excited about Brexit and what sterling means. So they're domestic players, so there's no currency angle, there's no pound down, dollar up, utilities up, with the possible exception of National Grid, which has got big US assets. So there's not the growth angle to them. No, definitely not on that. So they're almost seen as bond proxies, because people buy them for the yield. So the lower bond yields are, the more attractive the yields from utilities look. So now people are talking about Trump, growth, inflation, and bond yields are going back up again. That means the premium advantage the utilities offer is less exciting, and that's why they've lagged the wider market rally. So to say that they're completely safe is wrong, but generally speaking, their dividends, touch wood, should be fairly visible.
And I suppose as an investor, that's what you should be looking at. I mean, what more do you want? OK, you want to become a millionaire overnight, but I think that's impossible.
Doesn't work, I'm afraid to say. I mean, these are the ultimate compounding stocks. And there's that very famous quote from Warren Buffett about, why do fund managers sometimes potentially overtrade or not outperform as much as you'd like to think they can, given their investment professionals? Well, as he puts it, when their boss comes to them, nobody's going to say, what are you doing today? And they're going to say, I'm sat here doing nothing. Compounding, because that's kind of hard to justify your salary, even though that's actually what they should be doing, and that's what these stocks are there for. Now, this doesn't mean to say that there's nothing happening. National Grid is just in the process of selling its UK distribution assets, and it's therefore going to get a big cash pile coming in, and £4 billion of that it's planning to return that to shareholders in 2017 through buybacks and through special dividends. That tops up a normal 4% dividend yield, and on a 35 billion market cap, 4 billion extra coming back is a pretty big deal. It makes quite a big juicy yield. Severn Trent's in the process of buying D Valley, so again there's been a little excitement there, and that could spice up Severn Trent's growth. And the big one to watch, actually, regulation, I don't get excited about it too often, but there is a government white paper coming up looking at introducing competition in the water industry. Now, this isn't through people laying more pipes to people's houses or to businesses. It's more through billing and the provision of innovative services. But it could be interesting. It may mean that the water regulator, Ofwat, if it really wants water companies to embrace this and be innovative, it may cut them a little bit of slack on the pricing environment and let margins just bubble up that little bit higher. So you may get some earnings positive surprises, particularly from firms like Severn Trent, if this goes through, because Severn Trent has the lowest revenue per water customer in the country at the moment. So you never know. Keep an eye on that government white paper. It could actually stoke a bit of unexpected enthusiasm for the sector. So
regulation is not necessarily always a bad thing?
No. And no, not always. I mean, it definitely keeps things tight. I mean, these guys are limited to price increases of retail price index plus. But again, if inflation dribbles up and the RPI is now at 2.5%, you do get a little bit of inflation proofing through these companies for good measure.
OK. We've got our portfolio open now. I know you've selected a few companies just there, but have you got any more picks that nobody really talks about?
I mean, the one I haven't talked about there, because it's not in the FTSE 100, is Telecom Plus. It's a FTSE 250 company. It's had a pretty tricky 3 years, if the truth be told, because the shares, if you look at the chart, it's not that pretty. But they're starting to rally, and I think there are a couple of reasons for that. One, GB Energy unfortunately went bust at the end of last year. I know the co-op utility business actually hoovered up its customers, but this does show that rising oil prices, rising energy prices are putting pressure on some market newbies. So there's a chance for Telecom Plus to nick a few customers there, because Telecom Plus has got a 20-year energy supply deal with npower. So it's largely protected from any fluctuations in oil and energy and wholesale energy prices. So if oil prices really rise, Telecom Plus has got pretty fixed costs. It can nick business from the newbies, who may finding life hard, and from the established players like Centrica or SSE, for example. So that's one angle to it. Plus, it's not just one utility. It actually sells a package. It does telecoms. It does water. It does electricity. It's actually a fixed-line telecom stock, according to the FTSE categorisation. So it's got these bundles. It's undercutting a lot of established incumbents. And actually, there's a little bit more growth there than meets the eye. And there's a 4.2% dividend yield for good measure.
Wow, a pretty balance sheet then.
Touch wood.
All right, Russ Mould, thank you very much indeed from AJ Bell today, talking about the utility sector. And it turns out it is quite exciting after all.